G'day everyone, it's Mal Cheer here, back for episode 90 of This Week in E-Commerce, and this week we are turning it up again and cutting through the noise. We're seeing a lot of competing narratives out there, one of collapse, but also one of conquest, which are all happening all at the same time. And if you're building, funding, or fixing a brand right now, it just couldn't be any more high stakes. On the one hand, retail in Australia is cracking. We've seen insolvencies up nearly 20%, iconic players like Mosaic Brands and Jeanswest falling into administration, and the mid-market completely under siege. And on the other side of the pond, e.l.f. Cosmetics have just dropped a cool $1 billion on acquiring Rhode, the 3-year-old skincare brand led by Hailey Bieber. In today's episode, we're going to unpack, number one, why the Aussie retail sector is entering what some economists are calling a silent depression. 2, how Jeanswest, once a household name, collapsed under the weight of their inertia. 3, what e.l.f. really bought for $1 billion and why this might be the future of M&A. And finally, what this all means for you, the operator, the founder, and the strategist. But before we dive in, I owe anyone who I saw Thursday night at Retail Fest a quick apology. Let's just say a few executive decisions were made and tequila happened. Lots and lots of tequila. But a huge thanks to Ash, Luke, and the entire Retail Global team. It was another sensational event, and you somehow managed to make an industry conference feel like a reunion, a masterclass, and a bender all rolled into one. As always, it was amazing to catch up with so many excellent people in the retail industry. And if you weren't there, you missed out. Truly you did. But let's not waste any time. In May, 1,076 retail insolvencies were recorded for the financial year to date. Now, that's not a typo. That's the numbers according to ASIC, which represents a 19.25% jump on last year. Now, this is in fact the highest number in well over a decade, dating back to the recovery from the GFC. This is what Rag Trader is calling a silent depression. But to call it silence is deceiving because behind the stats are names. There are leases which have defaulted, there are creditors who've been unpaid, and there are staff who've been let go. And so many businesses that scaled up during the pandemic and never adjusted when the tap was turned off are now feeling it the hardest. But it hasn't been across the board. The categories that have been hit the hardest are the ones you've heard of before. The fashion and footwear industry are most likely the ones feeling it the hardest. These are heavy discretionary spend categories, which a lot of people, when times are tough, will stop spending on. Homewares has also seen a bit of a decline as well, but is nowhere near as compromised. Post-COVID, a lot of people got out of the nesting phase when they were buying a lot and sprucing up their homes. But we still continue to move houses and buy property like no one's business in Australia, which means the homewares market is always going to be there. But also variety stores as well. Those general stores have a bit of everything, have been really squeezed between the dollar shops who've now been coming in and clearing up anyone looking for value, and those DTC pure players. But yet a lot of these businesses didn't really have to die, because what they suffered from was actually strategic debt. Now, what I mean by strategic debt is that these are the common strategic failures which have hallmarked a lot of these businesses and why they're in trouble now. And these are through a lack of financial agility, where businesses who are still carrying a really bloated store network, such as Mosaic Brands or legacy ERP stacks, or just fundamentally way too much inventory, haven't been able to shift quickly because so much of their cash is tied up in inventory or fixed costs. They also don't own an audience as well. A lot of these brands do not have any sort of digital strategy, or at least not a robust one, and certainly no first-party data strategy, just a reliance on Meta, Google, and word of mouth to carry them through, but no real way to be able to leverage on the data, on the size of their network to be able to grow. And also weak merchandising as well, with no logic to replenishment, no rationalization behind SKUs, and no logic behind the ordering. But most pressing for me as a brand guy is not having a reason to exist, because they simply didn't matter to the customers. In Rag Trader's coverage, they've said that many of these brands were surviving on foot traffic and sales events. There was no community, no loyalty, and no story, just stock. And I couldn't support that anymore, because that's exactly what it is, where these brands have lost a position in the market. And because the broader macroeconomic climate also hasn't helped their cause either, because while we're seeing wage growth continue to be strong, which is great socially, it does mean that these retailers who rely on a lot of labor have seen a huge increase as well in their labor costs. After seeing leases being frozen for a number of years over COVID, the renewals are coming in much higher than they were after years of the standstills. And interest rates, a topic which we talked about quite often, while they have softened a little bit, it really hasn't been enough to spur consumer confidence, nor will it be for quite some time. So if any of these strategic failures sounds like it's something which your brand is encountering, there's still a window. There is still a window to reset, and now is the time to do it, where you need to start shifting away from growth and focusing on resilience instead. Looking at those different areas and thinking, how can I as a brand really strengthen those areas where we may be a little bit weak on, whether it be cash flow, whether it be inventory management, and actively starting to put things in place now that while you may incur some short-term pain, it will mean that you're still here in 12 months. Also moving away from just performance marketing to a full funnel strategy, really looking at how are you going to be speaking to customers through every stage of the funnel, from awareness to consideration to conversion, and really having a full story and that reason for why a customer should buy from you. And then looking at how you can build margin, not just through price, but through brand, so that you can command premium pricing. And this is a really, really critical part, because being able to command premium pricing means that you have margin. It means that you have margin to weather the storm. It means you have margin to spend and invest into new initiatives, because that is ultimately what has happened to one of these legacy brands, which is Jeanswest. Now, for those of you who were born before the 2000s, possibly in the 80s, maybe the 70s, Jeanswest was once a bit of a rite of passage. You probably bought jeans from there to your first date, your first party, and maybe even your first job. But that's where Jeanswest has stayed. Harbour Gardens Proprietary Limited, who are Jeanswest's parent company, have reported that they now owe $48 million to over 200 creditors, including the ATO, landlords, 3PL providers, and more. And they entered voluntary administration in May, only a few weeks ago, after years and years of slow decline. Now, this wasn't the first time they entered administration, because not even back in 2020, 5 years ago, they were already in administration before KPMG took over, trimmed the stores from 220 plus to 90 in order to rescue the business. However, in that time, they started to implement e-commerce pivot, but their site, while functional, was never going to be able to compete with the likes of The Iconic or even Amazon. And there was no infrastructure for loyalty. There was no CRM, there was no retention strategy, and e-commerce remained very much an afterthought for them. But when you look at the store experiences as well, and there is one just down the road from me, it did remain stuck in 2011. It was just about putting product out on racks or on shelves and hoping people walking through would walk in, something would appeal to them, and they would buy. There was no omni-channel innovation, there was no experience, there was just racks and discount bins. And what was most remarkable is that most people didn't even realize that Jeanswest had gone until they saw their headlines. Now, if your brand disappears and nobody notices, that is literally the story right there. And this needs to be a lesson that survival isn't just about price or even your product. It's about meaning. It's about, what does your brand mean now? What cultural relevance and what cultural capital do you actually have right now? And for Jeanswest, despite its history, had absolutely none left. Meanwhile, while Australia and the mid-market continues to collapse under its own weight of lack of differentiation and some poor strategic mistakes, over in the States, we've got a completely different story, where e.l.f. looks like they're playing 4D chess. Because on 31st of May, last week, e.l.f. Cosmetics announced that they were acquiring Rhode, which is Hailey Bieber's skincare line, for $1 billion. That's $600 million cash now, a further $200 million once the deal is completed, and an earnout of a further $200 million in 3 years' time. That's a valuation of 10 times its projected 2025 revenue of $100 million, which is just a crazy amount. When you think about multipliers now, it's so rare to see a multiple like that, even in the tech industry where some of these numbers come from. But that's what the multiple they've put on Rhode is, where e.l.f. feel that Rhode is barely scratching the surface to be able to put in this sort of money into it. And over 3 years, to grow sales to $100 million a year in 3 years is, quite frankly, mind-boggling to do. Because according to Forbes, e.l.f. didn't just buy a skincare line, they bought cultural distribution. There's that word again. Infinite shelf life and a media flywheel. Because when you look at Rhode aren't range in any stores. They don't even have their own bricks and mortar stores. And while they will be launching into Sephora soon, this is a D2C brand. They're a D2C founder-led, influencer-led brand who rely on cultural capital to grow. So let's take a look at how their media flywheel works. Now, traditionally in brands, D2C brands especially, we acquire customers through media spend. We're advertising on Meta, Google in order to acquire new customers. But in Rhode's case, they've got Hailey Bieber. They've used Hailey Bieber, her connections, to be able to grow the brand to 100 million plus reach and $100 million annual sales. They've also built a moat as well, not through the IP, not through formulas, not through the retail contracts. They've done it through brand affinity and D2C loyalty from people who identify with the brand and want to be part of the brand and will purchase from them time and time again. In terms of distribution, they're relying on Shopify to be their hub and pushing that out into other avenues, such as TikTok Shop, but also some limited marketplaces as well, but all driven through their D2C. And through marketing, while they do spend quite a bit on digital, they also rely very heavily on that virality, that organic and influencer reach and engagement to help spread the word about Rhode and help continue to grow. So in 3 years, what Rhode have achieved is more than what so many brands haven't been able to achieve in 10, in that they were, first of all, able to launch with cultural capital. And I cannot stress how important that is in this day and age, that your brand needs to be culturally relevant for it to stand out. They've then been able to scale through their community, not just relying on cost per click, but their community being fans and advocates for the brand, creating content and moments which people want to share, and created that emotional availability for the brand via their values and their aesthetics, so that young girls all over the world want to be part of the brand. And according to the CEO of e.l.f., Tarang Amin, their playbook is clear. That for e.l.f., they're not chasing distribution. They will acquire brands that already have distribution, just in a different format. And for Rhode, while they're not ranged in big retailers, it's not about the shelves. Their distribution is in the physical and mental availability, and the mental availability in particular, that they have with their customers. Because the Rhode customer doesn't just buy the product, they advocate for it. So while most Australian DTC brands are still optimizing for ROAS, MER, email open rates, they're too busy still begging for Chemist Warehouse to stock them. So what this deal should be for everyone listening here is that you got to think beyond that. You have to think beyond the ROAS. You have to think about the cultural relevance. How are you culturally relevant first? And then think about the ROAS. So what this means is that the game has completely changed. And we've talked about this time and time again, is that if you operate in this mid-market where you're not a luxury brand who relies on storytelling or a value brand who relies on price competitiveness, and you're in that middle section, Your brand is toast unless you can radically reposition yourself. And that whole era of growth without differentiation is over, because we now live in an era of Temu, Shein, where fashion and commodities can come out at a scale which you simply cannot compete with. So you need to know what is your point of difference and how are you going to stand out in this market, because attention is the most valuable currency in retail. So what should you do now? First of all, you need to be auditing your relevance. You need to understand, what does your brand stand for? What would your customers miss if you disappeared? And if you don't know those questions, you need to spend the time answering them, and you need to start rebuilding your business. Then you need to start thinking about, how do you own your audience? Marketplaces are not the place to do it. There is a time and a place for marketplace, but you need to own your customer data, which means you need to have a first-party data strategy which brings people back to your home base, which is your website, and then thinking about how you can capture that first-party data and layer it with zero-party data to provide more personalized experiences where you can create those cultural moments with your customers. Because then you need to build that media layer over the top of that data through podcasts, newsletters, YouTube Shorts, TikTok, not just ads, but thinking about the content which you can create, which can enhance that experience and make your brand a bingeable brand. Then you need to kill that addiction to discounts. And I know, end of financial year is here, and that's what most of this month is all going to be about. And by all means, I'm doing a bunch of these webinars as well this week. But you need to really think about what offers you're running. Make sure you're tiering them by margin, not just site-wide sales. And by all means, make sure that you're using discounting to drive strategic outcomes, not just desperately trying to grab cash. And lastly, to survive, you have to be building culture, not just commerce. Make sure you're collaborating with creators who actually use your product, not just influencers who you're just paying a fee to, who'll move on to the next thing. Invest in experiential retail if you're omnichannel. Really think about, how can you create a moment for your customers every time they walk into your store or your pop-up. And your brand has to be a vibe, not just the store. Because $1 billion isn't just about revenue, it's about resonance. So that's all we've got time for this week in e-commerce, episode 90. Retail, as we know it, is always evolving and it's always changing, but it isn't broken. That I'm 100% sure about. But you need to be willing to disrupt and disrupt yourself. So don't wait for it to happen to you. You need to be doing it. Don't chase what's trending, build something that lasts, and don't assume that people will care. You need to make them care. And if this resonates, send it to someone in your team, another founder, your agency. Because if you're still relying on Meta ROAS to fund your strategy in 2025, you need a hard rethink. I'm Mal Chia. Keep innovating, keep growing, and keep selling. And I'll see you all here next week.